Okay, let's jump right into this explainer and frame our journey today as a bit of a detective mission. We are going to learn exactly how to solve the mystery of incomplete business records. I mean, imagine stepping into a room and instead of a neat, perfectly balanced ledger, you're handed a shoebox stuffed with crumpled receipts, a couple of coffee-stained bank statements, and just a whole lot of questions. For a lot of small business owners out there, this isn't some entertaining true crime podcast. It's literally their daily financial reality. But don't worry, because we're going to dive into the forensic accounting skills you need to piece together these scattered clues and uncover the true financial health of a business. Here is our roadmap for cracking the case. We'll start with the missing records mystery, introduce our main tool, the statement of affairs, and then solve for total profit. After that, we'll uncover hidden sales and purchases, and finally, we'll tackle the boss level using ratio shortcuts and clues. All right, Section 1, the missing records mystery, a shoebox of chaos. Let's examine the scene of the crime. Picture this vibrant, super busy food truck called Over the Rainbow. They're out there serving up amazing food, dealing with a constant, chaotic flow of cash, credit card swipes, and supplier deliveries. But small, dynamic businesses exactly like this one often practice what's known as single-entry bookkeeping. They might just jot down a transaction once, or honestly, in the middle of a crazy lunch rush, sometimes not at all. So how on earth does the owner figure out if they actually made a profit at the end of the year with nothing but a shoebox of mixed receipts? Now, you might be wondering, why does this even matter? I mean, if the cash register has money in it, who really cares about having perfect records, right? Well, the stakes are incredibly high. Without a full set of double-entry accounting records, a business is basically flying blind. First off, there are absolutely no internal checks to prevent fraud or monitor runaway expenses. Second, poor decision-making just becomes the norm because you can't accurately compare this year's performance to last year's. Third, good luck walking into a bank for a loan to expand your food truck fleet. Banks need solid financial statements to give you any leverage. And finally, if there's ever a dispute with a supplier, incomplete records make it almost impossible to prove what actually happened. Moving on to Section 2, the Statement of Affairs. This right here is the foundational tool for our entire investigation. So in standard accounting, you'd have a statement of financial position. That's your pristine snapshot generated from a perfect double-entry ledger. But when records are incomplete, we have to use a statement of affairs. It simply lists the assets, liabilities, and capital for a business on one specific day. Think of it like a financial reconstruction. You literally have to go out and physically count the inventory. You check the bank balance, you tally up all the unpaid bills, and you list it all out. The difference between what the business owns, its assets, and what it owes, its liabilities, gives us our very first major clue, the owner's capital. Which brings us to Section 3, solving for total profit. It is time to learn the master equation. This equation is our primary magnifying glass. Think about it. If you have zero sales data and zero expense data, how do you find profit? You look at how the owner's wealth changed. Profit equals closing capital minus opening capital. Basically, if you end the year with more wealth than you started with, well, you made money. But wait, we have to adjust that number. We absolutely must add back drawings. That's the money the owner took out for personal use. Because, hey, that was profit the business generated before it left the building. And we also have to subtract capital introduced, like if the owner injected their own personal savings into the business mid-year, because that isn't earned profit, that's just an outside deposit. Let's ground this in reality with a quick case study. Meet Donnie's Corner Shop. Donnie, like many, doesn't keep full records. But we know that on January 1st, he put $40,000 cash and a $5,000 van into the business, and he owed $5,000 for that van. Assets minus liabilities meant his opening capital was exactly $40,000. Fast forward to December 31st, we prepared a statement of affairs and found his closing capital had grown to $56,000. During the year, he took out $5,000 for himself. Those are his drawings. And he put in $3,000 of fresh capital. So, using our master equation, $56,000 closing minus $40,000 opening plus $5,000 drawings minus $3,000 fresh capital, we can definitively prove that Donnie's Corner Shop made an $18,000 profit. Case closed. Now let's zoom out a bit and see how this builds into a complete system. What if we don't just want a single profit number, but we want full professional financial statements? Here are the 5 exact steps an investigator takes. Step 1, prepare that opening statement of affairs to find opening capital. Steps 2 and 3, summarize the bank and cash accounts to find your closing cash balances. Step 4, prepare total trade payable and receivable accounts, which we are going to talk about next, to calculate sales and purchases.
And finally, step 5, plug all those reconstructed numbers directly into standard income statements and statements of financial position.
All right, section 4, uncovering sales and purchases. If we are actually going to build a full income statement, we need to know what we sold and what we bought. We need to follow the money. So consider this. Do all receipts from customers equal your total sales for the year? If you look at your bank account and you see $100,000 in customer deposits, did you actually sell $100,000 worth of goods this year? The answer is a resounding no, and honestly, this is the trap that so many novices fall into. The crucial point here is learning how to reverse engineer the true number. Total sales is a combination of cash sales, which are straightforward, and credit sales, which are a bit tricky. To find your credit sales, you take the cash you actually receive from customers, but then you have to adjust it. You add the closing receivables. That's money customers still owe you at the end of the year for sales you made this year. But then you must subtract opening receivables, because some of that cash you collected back in January was actually just paying off bills from last year's sales. By adjusting cash receipts against what was owed at the start and the end of the year, you magically reveal the exact credit sales for the current year. It's brilliant. And you know what? The exact same forensic logic applies to figuring out your purchases. You can't just look at what you paid your suppliers. You take your total payments, add your closing payables, the bills you owe at your end for stuff you bought this year, and subtract your opening payables, the checks you wrote this year to pay for last year's deliveries. Doing this isolates exactly what you purchased in the current 12-month window. Welcome to Section 5. This is the boss level of our financial detective work, ratios, shortcuts, and clues. Sometimes, even the bank statements are missing. When that happens, we have to rely on the natural mathematical rhythms of the business itself. One of our absolute best clues is the rate of inventory turnover. This is simply the number of times a business sells and replaces its entire batch of inventory in a year. A highly profitable business moves inventory fast. If we know a local hardware store historically turns over its inventory 10 times a year, and we can physically count their opening and closing inventory to find an average, we can use this single ratio to reverse engineer their entire cost of sales for the year, even without a single purchase receipt. Let's explore another pair of vital clues: markup versus gross margin. Now, these are easily confused, but they are mathematically distinct. Markup looks at profit from the perspective of the cost. It is gross profit as a percentage of your cost of sales. So if you buy a toy for $10 and sell it for $15, that $5 profit is a 50% markup on the cost. Gross margin, however, looks backward from the sale price. It is gross profit as a percentage of sales revenue. In that exact same example, the $5 profit is only a 33% margin on the $15 sales price. Knowing exactly which ratio a business uses is literally the master key to unlocking missing sales or purchase figures. Let's look at a really punchy example of this: 60%. In one of our sourced case studies, a trader named Hanji had a cost of sales of $25,000 and total sales of $40,000. That generated a gross profit of $15,000. When we run the math on that, $15,000 divided by the $25,000 cost gives us exactly a 60% markup. Now, once an investigator establishes this baseline 60% markup, they can use it in future years to estimate sales, even if Hanji accidentally loses his records all over again. But what happens in the ultimate worst-case scenario? What if the clues literally went up in smoke? Let's talk about Mala's craft store. A fire swept through her shop in June, destroying her entire physical inventory. There was absolutely nothing left to count for a closing statement of affairs. So how does she prove to the insurance company what she actually lost? Well, by using the forensic techniques we've just discussed, Mala could prove a loss of exactly $1,000. Here's how she did it. She knew her opening inventory on January 1st was $500. She knew from bank records her purchases were $3,000 and sales were $5,000 before the fire hit. But most importantly, she knew her historical profit margin was 50%. So if 50% margin on $5,000 of sales means her cost of sales was $2,500. If she started with $500 of goods, bought $3,000 more, that's $3,500 total available. If her cost of sales was $2,500, then mathematically, $1,000 of inventory had to be sitting in the store when the fire started. The math proves what the physical evidence no longer can. Which brings us to our final thought for this breakdown. Are you ready to solve the financial mysteries hiding in your own shoebox of receipts? We've seen how to build statements totally from scratch.
how to reverse engineer cash flows to find your true sales, and how to use ratios to see through smoke and mirrors. The tools are all right there. The next time you look at a messy pile of financial data, don't just see chaos. See a puzzle just waiting to be solved. Thank you so much for diving into this explainer with me, and happy sleuthing!